In a single day, the customers of one American bank tried to pull out $42 billion. $42 billion in one day. By the time the sun went down, the bank was short nearly $1 billion in cash and, in the words of the state regulator, insolvent. The next morning it was seized by the government. Start to finish, from everything's fine to shut down, about 48 hours. This wasn't a small bank. This was Silicon Valley Bank, the bank for nearly half of all the venture-backed startups in America. 16th biggest bank in the country. And it collapsed faster than any bank in modern history. Here's the thing that should stop you. There was no theft. No missing money. No fraud. The bank did something completely ordinary, and the ordinary thing detonated in 48 hours, because the money could now move at the speed of a text message. To understand how it died that fast, you have to understand who banked there. Silicon Valley Bank was founded in 1983, reportedly over a poker game, to serve the one type of customer other banks found too risky, tech startups. And it became extraordinarily good at it. By 2022, by its own description, SVB banked nearly half of all US venture-backed technology and life sciences companies. If you were a startup, and your investors were famous venture capital firms, you almost certainly banked at SVB. So did the VCs themselves. That gave SVB a superpower, and, though nobody saw it yet, a fatal flaw. Its customers weren't a broad, sleepy mix of millions of households. They were a small, tight, hyper-connected tribe who all knew each other, all invested in each other, and all read the same group chats. Then came 2020 and 2021. Interest rates were near zero, and money flooded into tech, IPOs, huge funding rounds, cheap capital everywhere. All that cash landed in startup bank accounts, which meant it landed at SVB. Watch the deposits. At the end of 2019, SVB held about $62 billion. By the end of 2021, it held $189 billion. It roughly tripled in 2 years. Now put yourself in SVB's shoes. A tidal wave of other people's money has just washed in. You have to do something with it. And that decision, a boring, back-office decision about where to park cash, is the one that killed the bank. Here's what a bank is supposed to do with deposits: lend them out, or invest them, and earn a bit more than it pays depositors. SVB took the flood and poured a huge chunk of it into some of the safest assets on earth, US government bonds and government-backed mortgage securities. Safe, but with a catch. To earn a little more, SVB bought long-dated bonds, ones that don't mature for years. And it bought them in 2020 and 2021, when interest rates were at rock bottom, so those bonds paid tiny yields. By the end of 2022, SVB was sitting on a securities pile of about $120 billion, most of it in a bucket it planned to hold to maturity. Remember why that phrase matters, because it's the whole trick. When a bank labels bonds held to maturity, it does not have to mark them down on its books when their market value falls. The loss can just sit there. Invisible. And then, in 2022, the loss got very big. To fight inflation, the Federal Reserve raised interest rates at the fastest pace in decades. And here's the iron rule of bonds: when interest rates go up, the market value of old, low-paying bonds goes down. SVB was holding a mountain of old, low-paying bonds. By the end of 2022, the bonds in that hold-to-maturity bucket were worth about $15 billion less than SVB had paid for them. Sit with that number, because here's the gut punch: SVB's entire common equity cushion, the money standing between the bank and insolvency, was only about $12 billion. The hidden loss was bigger than the cushion. On paper, marked honestly, the bank was already gone. It just didn't have to say so. And it almost didn't have to. In 2018, Congress had rolled back a chunk of the post-2008 banking rules, raising the size threshold for the toughest stress tests and liquidity requirements from $50 billion in assets to $250 billion. SVB, at around $200 billion, slipped neatly underneath, into a lighter touch regime. Its own CEO had publicly pushed to loosen exactly those rules. The Federal Reserve's later postmortem would name that rollback as one of the 4 core reasons the bank failed. For a while, none of this mattered, because nobody was asking for their money back. Then, in early March 2023, they started to. On Wednesday, March 8, SVB tried to get ahead of the problem. It quietly sold about $21 billion of bonds, taking a real, locked-in loss of $1.8 billion, and announced it would raise more capital to fill the hole. It was meant to be reassuring. It was the opposite. To its customers, it read as a distress signal: the bank needs money right now. And remember who those customers were: the tight, network tribe. The message moved through the group chats and the venture world in hours. Several prominent VC firms told the startups they funded to get their money out. Not because there was fraud, but because in a bank run, the only losing move is to be last in line, and everyone knew it. So on Thursday, March 9th, they ran. But this was not people queuing on a sidewalk. This was founders and finance chiefs moving money with a few taps on a phone. In that single day, customers tried to withdraw $42 billion, about a quarter of the entire bank. By the close of business, SVB's cash balance had gone negative, short about $958 million it did not have. The state regulator's conclusion was one word: insolvent. There was no Friday. On the morning of March 10th, with regulators bracing for another $100 billion in withdrawals expected that day, they simply closed the bank and handed it to the FTIC. SVB's own CEO later put the speed this way: $42 billion in about 10 hours, roughly $1 million every second, and told Congress he didn't believe any bank could survive a run that fast. That's the real headline. Not the mismanagement. Banks are mismanaged all the time and limp along for years. The new thing was the velocity. A concentrated tribe of depositors, armed with mobile banking and social media, ran an entire bank in an afternoon. The chair of the House committee called it the first Twitter-fueled bank run. The Federal Reserve, more carefully, said social media may have fundamentally changed the speed of bank runs. Here's where it could have become 2008. SVB's depositors were startups, companies with payroll to make on Monday. And nearly 90% of the bank's deposits, about $151 billion, were over the FDIC's $250,000 insurance limit. Uninsured. On Friday, thousands of companies genuinely did not know if they could pay their people. So on Sunday, March 12th, the government did something dramatic. It guaranteed all the deposits, insured and uninsured, and opened a new emergency lending program letting banks borrow against those underwater bonds at face value, so no one else would be forced into SVB's fire sale. The panic was contained, though not before Signature Bank failed that same weekend, and First Republic followed in May. And the accountability? This is where it's important to be precise. There was no fraud and no criminal charges against SVB's executives. The CEO, Greg Becker, had sold about $3.6 million of stock 11 days before the collapse, under a pre-scheduled trading plan he'd set up just a month earlier, which is compliant but drew real scrutiny. As of now, the only case that has landed is a civil lawsuit from the FTIC, filed in 2025. Accusing former executives of negligence, mismanaging the very interest rate risk at the heart of this story. The Federal Reserve's own report called SVB a textbook case of mismanagement. And this is where it gets uncomfortable, because guaranteeing all the deposits, including the uninsured ones, broke a rule everyone thought they knew. The whole point of the $250,000 limit is that above it, you're supposed to be careful which bank you trust. That discipline is what keeps banks honest. By covering every dollar, the government arguably rewarded the startups and VCs who'd parked far more than the limit at a single bank. Without a second thought. Critics called it a bailout of the wealthy. Defenders said the alternative, thousands of companies unable to make payroll, and a panic racing to every regional bank on Monday morning was far worse. Both were right, which is exactly what makes these decisions so hard. The honest choice and the safe choice pointed in opposite directions. And who paid for it? Not taxpayers. The government recouped the cost, about $16 billion, with a special assessment on the largest banks in the country. The industry paid to clean up one of its own. So what actually killed Silicon Valley Bank? Not a con. Not a thief. The thing that killed it was the thing that made it great. Being the bank for a single, tight-knit, hyper-networked community was a superpower on the way up. It's why SVB grew so fast. But a concentrated tribe is also a crowd that can turn as one. When the fear signal hit, there was no diverse base of sleepy depositors to slow it down. Everyone got the same message, drew the same conclusion, and reached for the same exit, at the same time, through the same apps. Concentration is strength right up until it's fragility, and it flips in an afternoon. Underneath that was the quieter lesson. The loss that sank SVB wasn't hidden by fraud, it was hidden by an accounting label. Hold to maturity let a $15 billion hole sit politely off to the side, unmarked, while everyone agreed not to look at it. But a loss you don't have to report is still a loss. Reality doesn't care what bucket you filed it in, it just waits for the day you're forced to sell. Put those together and you get the real signal, and it was visible long before March, a bank whose depositors were all one kind of person, whose safety cushion was smaller than a loss it wasn't showing, in a world where money now moves at the speed of a rumor. The run wasn't a freak event. It was the system working exactly as it was built to, just faster than anyone had ever seen. If you want the version where the missing money really was a lie, and the regulators spent years protecting it, watch our film on Wirecard.